Resume recording. Well, thank you so much, Sean, for being here today. I really appreciate you jumping on here and going over this information. I think that right now in today's economy and in the market, and all the time, but especially now, we need to really understand what tools are available for our clients. And I think with such a high inflationary period such as we're in right now, I think that this is going to be even more of a relevant topic for clients. I'm excited to get your perspective and kind of what you're seeing on it, and also just some additional information. So when we're talking with clients, or when clients are thinking about this as an option, that they have the true education behind it. I know I've been in mortgage for 19 years, and there's so much misinformation and beliefs out there that are not accurate around reverse mortgages. So I think it's really important that people understand, the changes that have happened, as well as, kind of get over what the false beliefs are. So thank you so much for being on here today. I'm going to go ahead and stop my screen. So if you want to share your screen and the information that you're going over, that would be great.
Absolutely. Thank you so much, Kirsten, for having me on here today. Yeah, and I couldn't agree more with all those things that you said here, right? Changing, instability in geopolitics, rising inflation, volatility in the stock market. There's just a lot of things going on right now, a lot of uncertainty where, folks are looking for something that they can anchor to and really have something that they can know and rely and count on. And this is potentially, a great solution for that. So let me go ahead and share here so that I can go ahead and get this presentation going. Alrighty, great. Are you all able to see my screen? Perfect. So, again, thank you so much for having me on here today, Kirsten. Sean Stewart, Finance America Mortgage. And I'm sorry.
Are you still sharing your screen right now? Because we don't see it.
Oh, did it disappear?
It did.
I'm sorry.
I see your desktop. There we go. Cool.
Okay, so maybe it was on the wrong screen there. All right. So when I go to the presentation, it disappears?
Yes, it disappeared.
Okay. All right, we may have to just go through it this way then here, or let me see if I switch it to my other screen here. I apologize here in advance.
There we go.
Now you can see it.
It's gone.
It's gone again.
Nope, it left.
So strange. Okay, sorry about that, guys. Why don't we go ahead and we'll do it the old-fashioned way, and we'll scroll through here.
Yep.
So again, thank you so much for having me on, Sean.
Well, I'm not seeing your presentation still.
Oh, goodness.
So it went on. There we go. We're good. Okay, we're good now.
Okay, so Finance America Mortgage, specialized here in reverse mortgages, been doing it for a number of years. And, the one thing that I really love about it is that, again, like we talked about, it's really something that's here to stay. And it's a comprehensive tool that can allow retirees to really enhance their retirement and really accomplish the things that are going to be most important to them. So we're going to be covering a few different things here today on our agenda. We're going to be looking at the reality of retirement. We'll go ahead and cover the basics of reverse mortgage, and then take a look at, who potentially the reverse mortgage is really well suited and best suited for. And so first, reality of retirement is, let's go ahead and take a look at, what retirement looks like for these seniors. So number one here in our demographics, 330 million people here in the United States, with over 10,000 people turning 65 every day. So, that senior population is continuing to grow. And there really is that retirement crisis going on right now, where most people have not adequately prepared for retirement, and they just don't have a solution to be able to kind of bridge that gap. Now, I think the reverse mortgage could be a potentially great way to do that. And we'll go ahead and take a look at exactly how it could be accomplished. So the reality is here, the majority of households, households with over $1 million of net worth only have about $133 of actual savings, $133,000 of actual savings, with 10% of households having on average $156,000 in savings, but the majority of households, 80%, having less than $100,000 in savings for retirement. Um, and if you look here, 59% of Americans fear of running out of money more than death. Now, how scary, crazy, sad is that? Where people are more afraid of running out of money than actually dying. Scary statistic there, but it's a reality, and that's why I think that this is going to really speak to a lot of people here. Now, there's really four pillars of retirement, the four L's we like to call them: longevity, liquidity, legacy, and lifestyle. And so, to speak to longevity, again, people don't want to outlive their money. That's their number one fear out there. Is not having sufficient money in order to be able to continue maintaining even a consistent quality of life. Liquidity. Now, we all know that there's things that happen unexpectedly, or where you need additional cash, where possibly your fixed income, whether it be Social Security that you're collecting, maybe a pension, an annuity. The majority of retirees are on fixed incomes, and having access to that liquidity for those unexpected expenses is really paramount. And then legacy. How are you going to be remembered by your heirs? Is it going to be where mom and dad had to move in with the children, where they had to rely on their children financially in their later years? Or are they going to be the seniors who were able to help maybe their children again, whether it be with a messy divorce, help grandchildren finance education with college funds, be able to give maybe early inheritances, things like that. So legacy is also important to these seniors. And then lastly, lifestyle, right? We all look forward to retirement however, if you're not able to live the retirement that you look forward to, I don't know if that's really something that is worth looking forward to, if you're not able to afford the things that you've really dreamt and thought about doing during those years where you were working and being able to collect an income. And so statistically here, the top goals of retirement kind of circle back to those four pillars that we just spoke about. So the top three goals of retirement here is, again, having enough money to last your lifetime. Again, that's the scariest thing for these seniors, is they're going to run out of money or outlive their money. Remain financially independent. That speaks again to not only having access to liquidity and improving cash flow, but also not necessarily having to rely on family members or external sources in order to be able to maintain a quality of life. And then the third most important is seniors would like to stay in their home. They don't want to be taken to a senior living or assisted living facility. These people would like to age and live in the home that they're comfortable with. Now, if you look at the next three goals of retirement, these all kind of speak towards lifestyle, right? Spending time with family and friends, having enough money to pay for medical expenses, and pursue interests and hobbies. So again, looking at lifestyle and looking forward to those things that you planned on doing throughout retirement, where a lot of these folks, their reality of retirement is really much different than what they thought that it might be. So now that we've kind of covered, kind of what the reality of retirement really is for seniors out there, let's take a look at some of the basics of a reverse mortgage and how this, again, might be able to bridge that gap for these people and really allow them to live a more fruitful retirement, essentially. And so what is a reverse mortgage? It's really just a financial agreement that affords homeowners the opportunity to tap into equity to strengthen their retirement. Now, the literal definition is any loan secured against the home where repayment is deferred into the future, right? So no payments are required monthly. However, there are going to be some flexibility with that, which we'll go ahead and cover here in just a moment, but no payments are required. And there are two types of reverse mortgages. The first one is what you're all probably most familiar with, which is the HECM, or home equity conversion mortgage. This is the FHA product, which is insured and guaranteed by the FHA. And then here at Finance of America, we do also offer a proprietary product, which is called the Home Safe Reverse Mortgage, which is going to accommodate folks who have home values which exceed the FHA lending limits, okay, and still be able to take maximum advantage of their equity. Now, reverse mortgages are going to give borrowers more control. So like I alluded to earlier, it's really a flexible monthly payment. Now, no payments are required. You can pay interest-only payments. You can pick a monthly payment if you choose to. You can make regular payments to the reverse mortgages if you like, which will allow to create liquidity for you, which I'll go ahead and demonstrate for you here in just a moment. But again, the last one, most people choose not to make any sort of monthly payment, which is going to increase their cash flow each and every month, right? Now, secondly, it's going to offer you access to liquidity like we've been talking about. Now, what does that mean? Most of these people have, significant equity in their house. However, they just don't have a realistic way of accessing that equity, whether it be because they can't qualify maybe for a traditional refinance. So with the reverse mortgage, it's going to afford these homeowners, these seniors, with not only potentially eliminating their monthly payment for them, but it's going to allow them a line of credit, which has a unique growth rate attached to it. Again, I'll be illustrating that for you here in just a moment. You can take monthly disbursements, whether that be for a set amount of time, for 5 years, 10 years, 15 years. They want certain monthly allocations deposited to them. You can also take a lump sum of cash, or a combination of all of these options is also available, where you can potentially take a lump sum if you need to consolidate some debt, and then have the rest in a line of credit, which you can then access as needed. Now, what do most of these people do once they get a reverse mortgage? It's going to allow them to be able to leverage that equity, right? So they can make investments, early inheritances, maybe do some upgrading or remodeling to their home. As seniors, they spend more and more time in their homes, and it's very important for them to be able to live in a comfortable space that they're comfortable in. Most of these people may have been on fixed incomes for several years and haven't had the extra funds to be able to do some of the improvements that they would like to do. Again, important that they age in their own home, and this could help finance in-home care, consolidate debt, which is going to improve cash flow, right? So the options are really unlimited what they can do with these funds, which are all tax-free funds, okay? And so how exactly does this line of credit work? Because this is typically the most popular choice for seniors, having a line of credit that they can then tap into whenever that they choose. Now, the unique feature that the reverse mortgage offers is that line of credit that they have has a growth rate attached to it. Unlike any HELOC out there, let's say that their interest rate that they have on their reverse mortgage is 4%. The line of credit, as you can see, is 0.5% higher. The growth rate is 0.5% higher than their interest rate. So if they have a 4% interest rate on their reverse mortgage, their line of credit, whatever funds that they have in there, will be growing 4.5% each year, compound, and that gets added each month. So it's amortized monthly, but it's at 4.5% annually. So it can never be frozen or called due and payable due to market conditions. I know a lot of people lived through 2008 with the declining home values and things like that. All of a sudden, rugs got pulled out from underneath people. They thought that they had liquidity available to them, and then they get a call from the bank and say, you know what, that line of credit is frozen, and now we're actually going to be fully amortizing those payments. You no longer have those flexible payments anymore. That never happens with the reverse mortgage. Again, can never be called due and payable, can never be frozen due to market conditions. That line of credit is insured and guaranteed by the FHA. Now, another great and sometimes counterintuitive option or feature here is that the reverse line of credit can actually exceed your home value. Now you may be wondering, how's that possible, or what does that look like? And this graph here is going to go ahead and demonstrate that here. So these bars in the green are representing the amount of line of credit, funds in a line of credit, where the line graph here in the back is demonstrating home values. And so as you can see, if somebody took a reverse mortgage 20 years ago, they started out with $100,000 line of credit. With that growth rate attached to it, that line of credit is continuing to grow, again, compounding. And as you can see, home values here dipped in 2014, 13 through 14 into 15, and their line of credit actually exceeded the value of their home. And that actually, because of the compounding growth, you can see even with this astronomical move higher in home values, the line of credit still exceeded the value of their home. So that's a very powerful tool when talking to clients, being able to demonstrate that and how that line of credit is actually going to be working for you over time. And a lot of times people say, why do the reverse mortgage now? I don't need it now, or I'm still working, I'm still financially independent. I don't need the reverse mortgage. Well, this can be a great illustration of as to why it does not pay to wait, right? So again, using compounding growth, it's always the earlier the better. Now, what is going to, the number one question that people always ask is, how much can I get, or how much do I qualify for? Because again, that's something that's paramount to them, is having that money to be able to navigate through retirement. And so what is going to determine the available funds? Well, the age of the youngest borrower or non-borrowing spouse. So the reverse mortgage does require at least one of the borrowers to be 62 years of age or older. They can have a spouse who is younger than 62, which they would still qualify with the reverse mortgage with. But the amount of funds that they would receive is based off of the youngest of the two. And the reason for that is basically just actuary tables. The younger you are, the longer you're expected to live, right? Number two is going to be current interest rates. A lot of people think that the reverse mortgage interest rates are significantly higher than a traditional mortgage. That's just not the case. Reverse mortgage rates are very competitive with traditional mortgages, but prevailing rates is going to play a factor in the amount of funds that are available. But conversely, again, with that line of credit, the higher your rate is, again, that means the higher your growth rate is going to be, right? So it does offer an advantage on the back end. And then lastly, obviously the value of the home, or the FHA lending limit, which is $970,000, $800. Again, we do also offer the Home Safe product, which can accommodate home values higher than that, which I know is relevant in these areas that we're in. Now let's take a look at the qualifying factors. Again, a borrower needs to be at least one of the borrowers needs to be 62 years of age or older. They need to own their own home. Their home has to be their primary residence. All that means is they must live there at least 6 months and 1 day out of the year. They can still have their vacation home or their second home. That doesn't interfere at all with the reverse mortgage. It requires that they have about 50% of equity in the home, right? Loan to value about 50%. And then the property needs to either be a single family residence, a multifamily dwelling where the borrower is residing in one of those dwellings, or it can also be a condominium. Now, they will need to undergo a financial assessment, which is essentially something that is just determining whether or not they can keep up with their monthly and housing expenses. And the great thing is, FICO scores don't play a role in this. Debt to income ratios do not play a role in qualifying. And there are no reserves or cash that is needed in order to qualify for a reverse mortgage. So a lot less than what is required in a traditional mortgage. Shoot this one here. So there's a lot of misconceptions that go through with a reverse mortgage, and I apologize. Again, my slide is not working here. Let me see if I can. That's okay. So we'll go ahead and just cover a lot of the misconceptions here. So the first one is the lender owns the home. That is just not the case. The borrower maintains ownership, maintains title. The lender does not go on title with the borrower. Works very much the same as a traditional mortgage. There is just a lien essentially placed on the home, just like a traditional mortgage. One of the second misconceptions is that that the rates are significantly higher again than traditional mortgages. That is just not the case. They're very competitive and comparable with traditional mortgages. Another misconception is that both homeowners need to be over 62. Again, that is not necessarily the case. As long as one of the homeowners is 62 years or older, then we can still make it work, right? Another misconception here is that reverse mortgage is only for people who are needs based or can't again are not able to afford their retirement. That's not necessarily the case. Now, the reverse mortgage can certainly be used as a financial tool to help leverage and better your retirement. Now, what are the rules of a reverse mortgage? Again, have to live in the home as your primary residence, maintain your home according to FHA requirements, which means just make sure that it's in good shape, and continue to pay out property charges. So things like your property taxes, homeowners insurance, and homeowners association dues, right? So things that these homeowners were already paying to begin with. Again, homeowners keep title, ownership, and control. The HECM or reverse mortgage is just another mortgage. Now, what happens when the loan ends? Now, what happens there? Some people think that the lender takes the home, or, there's a lot of misconceptions out there what happens, but we'll go ahead and dive into exactly what exactly happens here. So there's three options when the loan becomes due and payable, which is when either the last borrower decides to sell the home, permanently move out of the home where it's no longer their primary residence, or passes away or fails to meet the terms of the loan. And again, those terms of the loan are things like keeping up with the maintenance, keeping up with those property charges. Number one is they can repay the loan. So the heirs potentially can repay the loan, or if the homeowners decide to move out, they can satisfy whatever the loan balance is and they get to keep the home. Number two is they can sell the house. Again, works just like any other mortgage. Sell the house, repay the balance, and keep whatever remaining equity is there. They can deed the home to the lender. So this is typically what folks will do if the loan balance is higher than what the home is actually valued at. So let's just say that the borrower had taken the reverse mortgage out, or the homeowner takes the reverse mortgage out while values were very high. They lived to 110 years old, which means that the reverse mortgage had a lot of time to be able to accrue interest and whatnot. And then there's a market crash where all of a sudden now the value of the home is less than what is owed. The heirs can actually deed the home to the lender, where they are not responsible to make up that difference. So the reverse mortgage is what is called a non-recourse loan, and that is where the FHA steps in, and the FHA insurance fund will actually make up that difference, where the heirs again will not be responsible. So the homeowner has doesn't have to worry about leaving any sort of debt to their heirs. Now, what is again unique to the HECM is, let's say with a traditional mortgage, the homeowner passes away, and then the heirs immediately take over the home, or the estate takes over the home. What has to happen, right? The estate or the heirs are required to make that monthly payment, or they're in jeopardy of being foreclosed on. Now, with a reverse mortgage, you have up to 6 months from the time of death of the homeowner to decide what to do with that home. So it gives the estate and it gives the heirs some time to figure out exactly what they would like to do. And in addition to that, they can actually request some additional 90-day extensions. Now, again, we talked about they have the ability to either purchase, potentially even refinance into their own name, or pay off the loan in order to be able to keep that property in the family or within the estate. Now who uses reverse mortgages? We'll go ahead and talk about a real life scenario here. This was a couple here, Jerry and Kathy, living in Northern California, and they had some goals in their retirement that they were looking at. They were looking to downsize, and they were looking for some more social interaction. They have about $200,000 in their retirement savings, and they were referred by a realtor. So the reverse mortgage plan here, they're looking at selling their $850,000 home, which is free and clear, and they're looking at purchasing a new home in Scottsdale, Arizona for $535,000, and they'll be using a reverse mortgage to purchase that home. So reverse mortgages are not only designed for people who already own homes, but they can be used to also purchase a new home, okay? So let's see exactly what that looks like. So selling their house in California for $850,000, let's just say, you know, after commissions and fees, $68,000, their net proceeds is about $782,000. Now they're looking at purchasing a new home again in Scottsdale for $535,000. The reverse mortgage is going to go ahead and cover $304,000 of that purchase price, where the homeowners now only have to come out of pocket with $231,000 as a down payment. Again, the remaining balance is going to be covered by the reverse mortgage. Now, this has allowed them to bolster their savings in retirement by $551,000. Adding that to the $200,000 that they already had in savings, all of a sudden they went from having $200,000 in savings now to over $750,000 in savings in retirement, which is going to be positioning them obviously much better, not only to do things like leveraging like we talked about, but also just have that security of knowing that they will have those funds available. So this is another scenario here. This would be somebody who is looking just to eliminate that monthly payment that they currently have. And this is a real life story here of Barbara. She's 74 years old. Her home was valued at $2 million, and she has a $450,000 mortgage currently, 15-year fixed, with a retirement savings of about $175,000. And she has now a monthly payment of over $3,200 per month. Now, again, we talked about cash flow and the importance of cash flow through retirement. And this is obviously by eliminating that monthly payment, it's going to save her $39,000 a year, which equates to $195,000 over 5 years, or $585,000 over the next 15 years. Not only that, but she was able to get a line of credit here for $458,000, which means over the next 15 years, the reverse mortgage has bolstered her retirement by over $1 million in real tangible liquid cash that she can access at any point in time over that 15 years. And so, you know, what's my ask of you here today after this presentation? You know, Kristen and I would like you to consider this product, you know, for your current database. You know, just talking about and thinking a little bit outside of the box, you know, from maybe what your traditional go-to products might be. But this is, you know, something for anybody who might be considering a cash out refinance, anybody who's looking for a rate and term potentially to lower their monthly payments, or again, somebody who's looking to potentially purchase a new home. All of those potential clients are potential reverse mortgage clients, right? So please keep us in mind when speaking with these types of homeowners or these borrowers, and let's work together, right? So we're here to work together. I'm willing to do any co-branding, marketing materials. Let's grow professionally. Work together at any educational events or seminars that you might have going on here. But again, really just like to partner up, and keep this in your toolbox as another potential option for your clients. Not only will they thank you, but we'll be thanking you as well.
Thank you so much, Sean. I really appreciate you going over the information. I do think that this is a season that we're going to go into, that this is really going to help people with their biggest concern, which is money. It is a huge concern with the inflation and cost of things going up. People are really in a tough situation, and our job as advisors to be able to provide options and resources to put them in a better financial situation. So I think it's really important that you remember, maybe even write this down as an option so that you remember and keep it top of mind when we're having these conversations on purchases, especially. I think it's something that people forget about. And so when we have a client that we're so eager, you know, and they come in, they're coming maybe from the Bay Area or a different area, and they want to pay cash for a home, being an advisor and taking a step back and asking them a few additional, questions is really important. You know, what is this all the funds that you have? what's, your retirement look like if they're retiring, what's your, where do you want to spend, what's your quality of life? Because if you can take that extra step that nobody even brought up or mentioned and put them in a situation that's going to be more beneficial for them to have a quality life in retirement, it's not just about retirement, but the quality of life in retirement, you win. Not only does it put you as an advisor, but it also is going to keep you as the advisor that they're going to also recommend because they know you have their best interests in mind. So I'm super excited to have the information. I know for me, I continually go back and revisit it because it's the same for me too. I need a reminder when I'm talking with my clients to keep this as an option when I'm checking in with them and doing the annual calls too. So thank you so much for being here on our Zoom call today and going over all the information. I really appreciate your time.
Thank you so much.
All right. Thank you. Have a great day.